Welcome to the lecture on options. So, we will talk about options today. We discussed about mutual funds in the earlier classes. Now, these options are the financial instruments that act like a standardized contract and provide their holders with the opportunity and right, but not the obligation to purchase or sell a certain asset at a stated price, that is known as the market price or strike price on or before a short term expiry date. So, that date normally is set as within a year. So, basically it will be it gives the holder the right to purchase a specific number of shares at a price called the strike price. So, that way you have they have the option and that too prior to a specific expiration date. So, the date is there. So, before that you have to do this work, otherwise after that date the things will expire. So, that is a specific number of shares, basically that is not written. So, normally you have three types of options. The three types of options are rights, warrants and then calls and puts. So, in most of the cases we talk about the call and put option, and in this lecture also we are going to talk about the put option and the call option. So, you have something like buying, or for sometimes you will have to do something like right to selling. So, based on that you have either a call option or a put option. So, these are the two types of options for which we have to talk. Call option will be giving the holder the right to purchase specific number of shares at a price called the strike or exercise price, and then so that will be your call option. And then if you talk about the put option, so it is similar to that call option, but only difference is that it gives the right to sell. So, when you have the right to buy, that is your call option. When you have the right to sell, that is your put option. So, then options are also called as derivatives, because their value will be depending upon the value of its basis asset. So, because you have the market price which will be varying, and based on that only its valuation is done. So, that is why they are considered as the derivatives. Now, the option trading cycle that will be beginning when an option contract is generated by the option writer, who will be giving a premium by the asset owner to create some option, and then it will be granting its selling and buying rights. So, certainly that rights for the selling and buying has to be given, and during the life of that option, that exercise is to be carried out. Now, the option holder, which will be monitoring, he can monitor his or her action based on the market prices. So, based on the value of the price, that is the market price, whether it is increasing or decreasing of the assets, and also that depending upon the level of risk involved, the option holder will be monitoring his action. So, this is about the options. Now, the option holder will be following the actions which are like this. Now, exercising the option, not to exercise the option, and let the option expire. So, as we told that you have a call or a put option, and either he can go for exercising the option, he can think of not to exercise and then let the option expire. Now, in the case of exercising the option, when the market price of the underlying asset such as the common stock, it is higher than the strike price of the option. So, that is the case when the market price of the asset, it will be like stock. Now, the strike price of the option is there, and if it is more than that the strike price of the option, then the holder of a call option would exercise his or her right to buy a call. So, certainly, I mean, since market price is larger and the strike price is smaller, so this holder of the option, they will exercise their right to buy a call and make a profit. So, in that time when the strike price is smaller and the market price has gone up, in that case if he purchases at a strike price, then in that case he will have the chance to earn a profit. Similarly, when the market price is lower than the strike price of the put option, so the market price has gone down and strike price is higher. So, at that time it's beneficial to sell it, because you are selling at a larger price than the market price. So, that way you are earning a profit. So, when the market price is lower than the strike price of the put option, the put holder would exercise his or her right to sell and make a profit. So, depending upon the value of the strike price, whether it is more than the market price or whether it is less than the market price, the buy or the sell option has to be exercised, and this case is known as the in the money. So, you are in the money, that is how it is defined. Now, this is not to exercise the option. Next option is that not to exercise the option, but then when we talk about in the money, so in the money, or in the case of when you are thinking of exercising the option. So, the in the money condition will be that when the market price for the call should be more than the strike price, or the market price for the put option, so that will be less than the strike price. So, that is MPC is the market price of a call. So, this will be market price of a call. Similarly, this will be market price of a put. So, this will be market price of a put. So, this situation is known as the in the money, and these are the conditions which should be satisfied. Now, then there is another action, that is not to exercise the option. So, when the investor does not see any opportunity to make a profit, in that case he will think of not to exercise the option, and this situation may come so that and this situation is also known as out of the money. So, this is in the money and this is out of the money, and this will be your exercising the option. And when not to exercise, so in the case of not to exercise the option, so in this case what happens that the investor does not see any opportunity to make a profit. So, he will not try to exercise the option, and in this case normally the market price, so market price is either equal to or lower than the strike price. Of call. or same as it is equal or higher for put. So, or equal or higher for a put. So, in that case so as you see that in this case when you have such signs, so in that case you have the opportunity to earn a profit, whereas if the market price is either equal to or lower, if this signs becomes opposite. So, if market price for the call will be less than SP, or market price for the put will be more than or equal to SP, that is strike price. So, in this case investor does not want to exercise his option of either calling or or either buying or selling. So, this this situation is known as the out of the money. So, out of the money means in this case when it is less than equal to. So, in that case MPC will be less than SP or MPP will be more than SP. So, that will be your out of the money, but when it is equal, in that case it is known as at the money. So, in the case of at the money you will have MPC will be same as SP and your MPP it will also be same as SP. So, this is known as the not to exercise the option or out of the money option. Then comes the to let the option to expire. Now, in this case the investor will be keep waiting for the prices of the underlying assets to change in their favor. So, basically the investor will be waiting and waiting, so that he will be anticipating that there will be change in the prices in his favor, so that he can earn profits, and you can take the option and he does not take, he is not able to take the action till the expiry date arrives, and then that option becomes worthless. It's like a loss. So, that is basically the known as the letting the option expire. So, this is the three type of action which is being exercised in the case of options. Now, the strategies which are used by the financial institutions to protect against this loss and other type of loss in the investment market. So, you have many kind of strategies, and one of the strategies that is hedging. Now, hedging is the action taken with one security to protect another security against risks, such as buying on one side and selling on the other. So, this way you are having these steps so that you are protected against the risk. So, in the option investment you have three common types of strategies, that is spread, straddles, and a combination of both. Now, what is spread? Now, spread is basically it is a simultaneous purchase and sale of calls and puts on the same underlying assets. So, it will be basically the simultaneous purchase and sale of the calls and puts, like a stock which are written with either different strike prices, different expiration dates, or both. So, in that case we use this we exercise this spread So, in that case you have three types of spreads which are defined: the horizontal spread, vertical spread, and butterfly. So, the horizontal spread is characterized by buying and selling an option with an identical strike price, but different expiration dates. So, as we know that in that case you are simultaneously buying and selling, but here the strike price is identical, but you have different expiration dates. Similarly, the vertical spread will be involving the purchase and sale of option with identical expiration dates, but the different strike price. So, you are taking purchasing and selling the option which have the similar same expiration date, but the different strike price is there. And then the butterfly is there, which represents many options purchased at different strike prices. So, that is known as the butterfly. Apart from that, you have also the straddle. Now, straddle is defined as the combination of the same number of calls and puts purchased simultaneously at an identical strike price for the same expiration rate. So, that is the example of this, that is the definition of straddle, and that is how straddle is defined. Now, we will discuss about the intrinsic value of calls and puts. So, we will be talking about the valuation of the calls and puts options. Now, intrinsic value of a call option to the buyer is what he would gain through the difference between the market price of the underlying stock and the strike price. So, we know that when there will be difference in the market price and the strike price, then there will be certainly the profit or that will be the value of the option. So, he would gain only when the market price of the underlying stock exceeds the strike price, when he chooses to exercise his option right to buy at the strike price and sell at the market price. So, certainly if he purchases or buys at the strike price and then sells at the market price which is higher, in that case he will be earning the profit. He would not lose anything if the market price of the stock decreases, because he has the choice not to exercise his option, but wait for a better opportunity. So, certainly if it decreases, then he can wait for the better opportunity to come. Now, intrinsic value of the call writer is what he loses when the market price of the underlying stock increases, at the time he issued the option at a strike price less than the current market price of the underlying stock. So, basically what we say that you can calculate these intrinsic value of the calls and puts. Now, in both the cases he has so depending upon the condition, it is defined that the intrinsic value of a call. So, intrinsic value of a call to a call buyer. So, that is normally represented by intrinsic value of the call, so IVC, that is for B. So, this will be basically maximum of MP minus SP and then 0. So, when the market price of the call is higher, in that case you have this is the MP minus SP. So, and the intrinsic value of the call to for a call writer. So, that will be W. So, it will be minimum of the SP minus MP, and this will be 0. So, MP is the market price and SP is the strike price of the call option, and you will have one for a buyer and one for a writer. So, suppose if you try to understand by one example, like if you have a call option is written and a call option is written for strike price, So, suppose strike price is $25 now per share. So, that is for a common stock. So, a common stock is there, normally it is exercised for common stocks. Now, suppose after some time, so suppose after some time market price has gone up. So, market price will go, in that case chance of making profit. So, market price has gone up and to $37. Now, what will be the intrinsic value of the buyer and the writer? So, intrinsic value for buyer and writer will be what? So, as you know that for the buyer, since it is the market price has gone up, so he will be getting some value, so some profit. So, if you take intrinsic value for the call for a buyer, so in that case it will be maximum of MP minus SP. Now, SP was 25 and MP, that is market price, has gone to 37. So, it will be 37 minus 25 and then 0. So, it will be maximum of these two, and this is 12 and 0. So, it will be 12. So, similarly if you talk about the writer, now it will be minimum of SP minus MP. So, SP is 25 and this is 35 and then you have 0. So, out of the minus 12 and 0, your minimum value is minus 12. So, this way what you see that you are getting the IVCB, that will be 12, and this will be and for the writer it will be minus 12. Now, what you see that whatever the buyer gains, the writer will be losing. So, this is what is happening in the case of when you are your price has gone up or down, then how these values are changing. So, this can be computed, and this can be also represented basically graphically also, like you have so that can be represented like it is going, and then one side you have, on the positive side you will have the IVC of the buyer, so that will go up. So, basically it goes, so one side it will go up and another side it will be down. So, this will be IVC of buyer and this will be IVC of the writer. So, that way your this will be, so this will be buyer's call and this will be your the writer's call. So, that way you normally represent in terms of so this will be profit and this will be loss. So, that way it is represented, and the price price is like this, and when price has market price has gone up. So, you will have this as the IVC of buyer and this will be the IVC for the writer. So, that way these values are changing. Now, so what we saw that this is how these intrinsic value of the options are exercised in the case, a similar case in the case of put also. So, that way you can calculate the values and find the intrinsic value of these calls and puts. Now, coming to so puts are basically the opposite of calls, and the intrinsic value in this case will be same as the call value expression, except in switching the order of the prices. So, basically in that case your in case of puts IVC IVP. So, when we talk about the put case, so in the case of intrinsic value of puts, so so in the case of put it will be maximum of SP minus MP and 0. So, that is how IVP, intrinsic value of the put, and that is for the buyer. So, that will be basically maximum of SP minus market price and 0. And similarly, IVP, that is value of the put for the writer, it will be minimum of MP minus SP, and then it is 0. So, basically this is how you try to calculate the intrinsic values for the calls and puts. Now, the put buyer will seek a drop in the market price of the underlying stock, so that he can make a potential profit through buying chicks. So, certainly in that case he will be thinking that the market value should be dipping somewhat, and the put writer on the other hand would make a loss by delivering an option at a strike price higher than what the market sells. So, both way when such data is available to you, you can find these intrinsic values of the calls and puts for the buyers or the writers as the case may be. Now, before that, before we end, we must also know something like the time value of the call on and option. So, something like time value of calls and puts. So, time value of calls and puts, it is basically the difference between the option price and the intrinsic value of the option. So, time value for a call. So, that will be basically the difference between the option price. So, that is OP, and it will be the intrinsic value of the call option, and and time value of the put. So, this will be basically equal to the option price and minus intrinsic value of the put option. So, that way it is defined as the portion of the premium above any in the money premium. So, that way it is known as the time value of the calls and puts, like we may understand through certain example, like a call option. So, that is is currently worth $600 and for a share, and its strike price. So, that is $40. So, you have to find the time value of the for its buyer. So, to find time value for its buyer, if market price of stock increases to $45. Let us say this is the situation where the option is currently worth $600 and strike price is 40, and your you have to find the time value for its buyer if market price of the stock is increasing to 45. So, in that case if you find the IVC, so that will be IVC for the buyer, it will be basically the maximum of the market price minus strike price. So, market price is 45 and the strike price is 40 and of 0. So, it will be basically 5. So, IVC B is basically 5, and this is for basically here the number of shares is 100. So, number for 100 shares. So, number of shares are 100. So, in that case if you look at, so this is $5 intrinsic value of the call for the buyer, it will be $5, And if you look at the option price, so option price basically is you have the worth is 600 and you have 100 shares. So it will be $6. So if you look at the TVC, so it will be OP, that is option price, that is 6, and minus for the intrinsic value of the call for buyer, that is 5. So it will be $1. So that way you can calculate the time value of the calls and puts. Similar case can be for the put also, and in that case you are going to have the OP minus IVP. So you have to find IVP and then you will subtract from there. So that way you can get these time values of the calls and puts. Thank you very much.